Greetings, and thank you for joining us today. I'm Steve Kamin, a senior fellow here at the American Enterprise Institute, and it's my pleasure to welcome you to this afternoon's event on prospects for the U.S. and global economies. I especially wish to welcome our panel of highly distinguished experts to this afternoon's session. By way of introduction, many of you may note that economists haven't done the best job of forecasting during the past few years. Most of us failed to predict the sharp upsurge in inflation that took off in 2021, and then as the Fed boosted interest rates in 2022, most of us confidently and erroneously predicted a recession by the following year, or at least I did. But anyway, as 2024 gets off to a start, economists are humbled not only by their record of past failures, but also by the unusually wide uncertainties about the prospects going forward. President Truman famously expressed his desire for a one-handed economist. But these days, the outlook is so murky and the range of possible outcomes so wide that what we really need is a three-handed economist. So, on the one hand, many indicators currently point to a soft landing. CPI inflation has declined from its peak of 9% in the middle of 2022 to 3.3% last December. GDP and employment growth have slowed from their earlier unsustainable pace, but remain quite solid. And the Fed appears set to reduce interest rates this year, further supporting the soft landing scenario. But on the other hand, there are plenty of indications that the Fed's rate hikes are starting to bite. Consumer credit delinquencies are mounting, corporate defaults and bankruptcies are moving up, and banks are tightening credit standards. If inflation and, as a result, interest rates prove slower to decline than investors expect, this could upend financial markets and trigger a recession. The struggles of the European and Chinese economies to get back on their feet should further weigh on U.S. growth. And on the third hand, there are some bigger landmines on the road to recovery than just a garden variety recession. The pandemic rise in working from home is leaving a big hole in commercial real estate, and this puts at risk a large swath of regional banks that are already suffering losses due to soaring interest rates. A resurgence of the banking problems we saw last spring, combined with weakening household and corporate balance sheets, could be very dangerous indeed. So, if the presentations of our experts leave you with a clear picture of where the U.S. and global economies are heading and exactly how they will end up, either they'll have misspoken or you'll have misheard. But I can't think of a better group of panelists to sort out these issues and highlight the key factors that'll affect the outlook. In the order in which they will speak, they are: Jason Furman is the Aetna Professor of the Practice of Economic Policy at Harvard University, as well as non-resident Senior Fellow at the Peterson Institute for International Economics. Among many other activities, Jason has been a top economic advisor to President Obama, including chairman of the Council of Economic Advisors, an advisor on economic policy during the Clinton administration, and he's also headed the Hamilton Project at Brookings. Julia Coronado is the founder and president of Macro Policy Perspectives, as well as a clinical associate professor of finance at the McCombs School of Business at the University of Texas at Austin. Before spending more than a decade as a financial market economist, Julia worked on the staff of the Fed in Washington, D.C. for 8 years. She's just finished a stint as president of the National Association of Business Economists, is on the advisory board of many institutions, and is a regular commentator in financial media. Nathan Sheets is the global chief economist for Citibank. Prior to that, he was chief economist for PGIM Fixed Income, undersecretary of the U.S. Treasury for International Affairs under President Obama, global head of international economics at Citi, and director of the International Finance Division of the Federal Reserve. In that last position, he advised Chairman Ben Bernanke and helped design the Fed's international response to the global financial crisis. He was also my boss, a thankless task.
It's true.
Finally, Desmond Lachman is a senior fellow and a colleague of mine at the AEI, where he writes extensively on emerging market issues, monetary policy, and the financial system. Before that, he was managing director and chief emerging market economic strategist at Solomon Smith Barney. Desmond previously served as deputy director in the International Monetary Fund's Policy Development and Review Department. If you in the audience have questions you'd like to ask of the panelists, you can send them to Beatrice Lee via email or Twitter as indicated at the bottom of your screen. And so, without further ado, let me give the floor over to Jason to begin our discussion.
Great. Steve, thank you so much for having me back. It was so gracious for you to do it that I hate to start by disagreeing with your opening. I'm not going to disagree on the forecasting being terrible. I'm not going to disagree that there's a huge amount of uncertainty, so you need a three-handed economist. I'm not sure that uncertainty, though, is any bigger than it ever is. Our confidence intervals on forecasts of year-ahead inflation are about 2.5%. On 90% confidence intervals, about the same on GDP. There's always a lot of uncertainty. We always think if you wait another 3 months, it'll all be clear. But not only is it never clear what's going to happen in the future, often you're arguing over the historic data 3 months from now. But let me just start out by sharing what my thoughts are. There have been 2 years of, we're going to have a hard landing or we're going to have a soft landing. And it was driving me crazy that people were having this debate over and over and over again. And I had no idea what they meant by these different words. And I had no idea what they meant by a narrow chance, a possibility, maybe, etc. And so I sat down to write down a quantitative version of what these meant and probabilities. And you could argue with the quantitative version, but at least it lets you focus the conversation. And so in October of 2022, I posted on Twitter a soft landing. I defined it as the inflation rate in the second half of 2023 being a less than 3% annual rate, maximum unemployment rate being less than 4.5%, which roughly corresponded to a recession. I polled people. I got 24 numeric responses on Twitter. The average out there for a soft landing of the people I polled was a 17% chance, soft landing defined in exactly this manner. I said I thought there was a 10% chance that this would be the event that occurs. We do not have the final inflation numbers for December, but we do know the maximum unemployment rate was 3.8. There was not a recession. And there's a little bit of suspense as to whether the 6-month annualized inflation rate will be 1.7, 1.8, or 1.9. But it's inconceivable it'll be anything other than those numbers and certainly won't be above 3. So by the definition I set out over a year ago, we have had a soft landing. And we're there. Now, could the plane still veer off on the runway? Absolutely. It's not, you're never done. Any policymaker that says mission accomplished, I would be nervous about and have some serious reservations. So one is the risk of resurgent inflation. This is one way of thinking about it. It's basically model free. And it largely says, let's look at the past. And if you've ever had a situation where the inflation rate, core PCE, was 1.8 over the last 6 months, what does it look like over the next year? How often does it go up by 1 percentage point, 2 percentage points, down by that, etc.? Historically, the behavior of inflation has been very skewed. And if you look based on where we are now, the types of bounces we've had and unexpected pops in inflation before, there's about a 12% chance inflation would be above 3% over the next year. And inflation, I mean core PCE. Obviously, inflation itself has more variance. As I said, this is model free. When I look at the economy, I'm a bit more nervous than I would be based on this historical experience. The reason I'm a bit more nervous is that not all the pieces of the economy have fallen into place yet in a new low inflation or normal inflation at target inflation equilibrium. In particular, if you look at average hourly earnings, they have slowed a little bit over the last year, but only a little bit. And they are rising at a pace that you would normally expect to have about 3 to 3.5% inflation. If you look at the ECI, which we only have through December at this point, or the Atlanta Fed tracker, they're more like 3.5 or 4. So if you thought wages led to prices, you would think we would be in a 3 to 4% inflation world. I think the most dominant probability is that the opposite is true, that wage growth, real wage growth has still been relatively weak over the last several years. That's bad for workers, but it's good for the inflation outlook because I think there is room for real wages to rise to bring us back to the type of normal relationship between wages and prices. And so I think wage growth is going to slow over the next year. It's going to slow in a manner that is consistent with the Fed's inflation target. But if core inflation comes back and we're talking about our bad forecasts again a year from now, it'll be because I was wrong about that direction of causation. And anyone who has any great confidence on whether wages affect prices or prices affect wages, I think isn't thinking about the issue seriously. It's really hard to disentangle that direction. The other way the plane could veer off the runway is a recession. After people got the growth number for Q3, just that blockbuster 4.9% GDP growth, they said, no recession, recession is gone. And for the fun of it, I went and looked at what the annualized growth rate was in Q2 and Q3 of 2007. It was even better at 3.9. We had a recession 2 months later. I looked at what it was in 2000, and these are the original reports, by the way. It was 4.2. We had a recession 5 months later. So you should not look at GDP growth, say it's strong, therefore we can't have a recession. The economy can turn quickly. Moreover, the data we're looking at could be wrong. To be clear, I'm not saying every time the growth rate is between 3.7 and 4.2, you have a recession shortly thereafter. I'm just saying there's nothing in the great historic data that gives me a whole lot of confidence going forward. When I look forward, what do I think about? My risks from most to least likely are roughly repricing of financial conditions because of a misunderstanding of the Federal Reserve. I think markets are a bit too optimistic about Fed's rate cuts, the higher for longer rates and what it'll mean for commercial real estate. Maybe I don't think there's a lot of lags in monetary policy, but maybe that's wrong. Consumers running out of steam, possibly due to resurgent inflation. We've seen more borrowing, although the borrowing, I think, is still at a relatively low level relative to income. And then, of course, there's geopolitical risks that I think are always a big part of these conversations and are generally actually a small part of US recessions. How do I add all of these up? We have such a terrible track record on recessions that I've mostly gone back to my standard model, which is it's a 15% chance in any given year. Maybe I'd be a little bit higher given all of this right now. So we had a soft landing, at least as pre-registered definition that I put forward 14 months ago. Why did it happen? Well, there's been a debate about whether the Fed deserves credit. A lot of that says, oh, the unemployment rate didn't rise, so the Fed didn't do anything. Well, you can't ask the question of did the Fed deserve credit without doing a counterfactual. This is made up illustrative. It's actually not totally crazy, and it lines up with some models, but I'm not pretending that this was a model. If the Fed hadn't acted, we probably would have had an even lower unemployment rate and even more favorable inflation rate. A big part of the disinflation has been good luck from a bad supply shock turning into a good supply shock. That good luck has only translated into 2% annualized core PCE because the Fed sort of locked it in and prevented the extra demand from happening. The economy was awash in demand last year from expansionary fiscal policy. This monetary policy basically fought it to a draw. That's why we didn't have a recession, but that's also why we didn't have an even bigger boom and even more inflation. The other thing is demand does seem to have weakened. My own preferred metric, if I could only have one for labor markets, and Julia will have her say on this if she wants to, she has a different view, is to look at job openings per unemployed worker. They peaked at 2. They're now down to 1.4. That's a large change. That's a nearly 2 standard deviation weakening in the labor market. So the weakening happened in a wonderful way with fewer openings rather than more unemployed people, but it really is a weakening. Moreover, the data is less clear, but I think output has also weakened a decent amount. GDP growth over the last 4 quarters is 2.9% annual rate, but if you add up on the income side, the economy contracted 0.1% over the last year. I've long thought that these 2 different ways of measuring the identical concept have similar amounts of measurement error in them. And based on work we did at CEA, led by Claudia Somm, we came up with the recommendation that you average the two. We called it gross domestic output, and that would be 1.4% over the last quarter. The Philly Fed's GDP plus is 0.7. All in, I think it is likely that growth was below the economy's roughly 1.75 potential over the last year. That's consistent with what we've seen in the labor market if you look at hours, not just at employment. And so I think we did have some softening of demand. Finally, perhaps the most important thing the Fed did was it moved really, really quickly, and that kept inflation expectations anchored. Basically, it is free to lower inflation to something like expectations or inertial inflation. It's really costly to try to bring that down. And we've had mostly the free disinflation. So what does this mean about what should happen next? There's a dovish fallacy I sometimes hear people saying. It goes something like in 2019, the economy had similar inflation and unemployment. We had about a 2% Fed funds rate then. That's what we should have now. Well, that's a fallacy because the outcomes we have are because of the high rates. Without the high rates, those would go away. Those rates have restrained demand. They have cooled the economy. Moreover, the neutral interest rate is probably higher than it was in 2019. There's also a hawkish fallacy, which is that inflation is not contained and could be reemerged. Inflation is much lower than it was. The risks are roughly balanced between resurgent inflation and recession, which has not been the case, at least in my view, for the last few years. The economy has much less support for demand from fiscal policy going forward. And real rates are higher now than they were even a few months ago. As expected, inflation has fallen. So what do I think should happen? In my modal case, I would cut rates every other meeting starting in March. So you get 4 rate cuts for the year. If a serious recession fear emerged, 25% chance of that, cut rates more aggressively. If inflation starts to resurge, I put that more at a 15% chance, then maybe even raise rates by as much as 50 basis points. Average across all of that, and I'm at roughly 140 basis points, which is a bit less than market expectations right now, but more than the Fed put down in the SEP. I'll end where Steve began. Every single thing I said is probably going to be wrong in one way or another, except the statement that I just made. Thank you.
Jason, thank you so much for that very interesting and stimulating presentation. I'm tempted to agree with you that maybe the uncertainties are always very wide. I think every FOMC meeting I ever went to had somebody saying the uncertainties are unusually great. So have to say I'm a little taken aback by your transformation from a hawk into a dove. And if there's anything you'd like to say about your personal journey, we'd all be interested in hearing it. But more specifically, there's a prominent view out there that most of the disinflation that we've seen to date has reflected supply side developments, including normalization of supply chains, reductions in energy, et cetera. And that the last mile to 2% inflation is going to be the toughest, and it's going to require more monetary restraint than a lot of markets anticipate. So I was wondering what you thought of that.
So first of all, I don't think of myself as a hawk or a dove, because that to me is like a prior. I think of myself as somebody who's always correct because I follow the data and change with it. No. And look, the data's changed a lot. I did not think the inflation rate on a 6-month annualized basis, core PCE, would be below 2.5, let alone below 2.0. And when the facts change, you change your mind. In my modal recommendation, you're only cutting rates by 75 basis points this year. So you still have a Fed funds rate of 4.5%. A year and a half ago, 4.5% seemed like a high Fed funds rate. In fact, there were even some hawks saying, raise the Fed funds rate to 4.5 to 5. And so, in some sense, I think I'm still being quite cautious and nervous about resurgent inflation. That's reflected in my views. And I think, frankly, there's some other people I look at who are saying, the Fed shouldn't cut, they should wait. And I don't quite know what they're thinking. I mean, real rates are much higher than they were. inflation is much lower than they thought. If you sort of pre-register your views and you say, if the economy's here, here's what I think, and then the economy isn't here, you should change your views. And so to me, I don't know. I think I'm still at the hawkish end of the spectrum. But then there's some people who want even higher rates than me, and I describe them as crazy and unbased, not hawkish.
All right. Well, that's
And I'm sorry, I don't do a lot of ad
no,
hominems.
I applaud an effort to make a sterile kind of like intellectual discussion a little bit more ad hominem and vitriolic. Uh,
That's what you have me for.
yeah, exactly. So why don't we see whether Julia can either raise or lower the temperature
Yeah,
this year?
yeah. I will do my best. Thank you, Steve, and thank you, Jason. I have some healthy areas of agreement and disagreement with what Jason just presented. And so I will share my screen with you here. And all right, let's just start this slideshow from the beginning. All right. I don't recall if I answered Jason's survey on Twitter, but I would have been in the soft landing camp. We were, in fact, predicting unemployment not to rise a whole lot and inflation to come down. At the beginning, this time last year, we were not in a recession camp, and we had a very simple reasoning for why, and that is we were running at above 350,000 jobs per month on a 6-month basis, 6-month average basis in December of 2022. Every cycle features at its core a positive feedback loop between hiring and firing. The other element, and that looked very, very strong. The US labor market is extremely diversified and moves like an ocean liner. So despite the rapid fire Fed rate hikes and the removal of fiscal support, it still seemed like there was lots of organic momentum. And it was broad-based. I agree with Jason that the risks actually, to me, look more balanced now coming into 2024. There are risks of a recession. Actually, to me, the risks of a recession are higher now than they were at the beginning of 2023, because hiring is now below 200,000 on a 6-month average basis, and it's extremely narrow. One of the criteria of NBER for recessions, declaring recessions, is the breadth of growth or contraction, and the breadth of hiring is very narrow. We've also seen some worrisome indications in surveys. So the ISM non-manufacturing survey showed a big drop off a cliff. Can be very noisy, doesn't give a lot of false signals because it measures the service sector, which is the dominant driver of the US economy. And consumer perceptions, the lower right-hand side chart here shows the Conference Board's labor market differential against the ISM. The top chart shows you, the big three hiring sectors: leisure and hospitality, education and healthcare, and state and local governments. Together, those three sectors accounted for all the hiring in the second half of the year. So that's the narrowness of the hiring. So bottom line is every other sector hiring has effectively ground to a halt. The lower chart shows you the ISM non-manufacturing employment index, even a 3-month average of that, which excludes some of the noise and outliers, or reduces their impact. It looks a bit worrisome. And then the Conference Board labor market differential, consumers' perceptions of the labor market, they're okay. They've come down. The Conference Board is the consumer sentiment measure that hasn't shown the extreme doom and gloom that the Michigan survey has, because it is driven more by the labor market, which is great. But it has come down, and it's come down below the sort of 2018, 2019 levels. So there are signs under the hood that the job market isn't quite as rosy. and that demand has cooled pretty notably. And that's a point that Jason was making. Monetary policy does work to cool demand, and we see that very clearly in the labor market. On the inflation side, we have a bit more, our framework for forecasting inflation is sectoral. We do both top-down macro models and bottoms-up sector analysis. And what we are sort of sympathetic right now to kind of the regime change idea in inflation, put forth by the likes of Jim Bullard, for example, that inflation doesn't move in a linear fashion with growth. Not all growth is inflationary. Not even labor market slack doesn't move in a linear fashion with. But it can move in regime. So you can have a combination of factors shock you into a higher regime, and a combination of factors shock you into a lower regime. And I think that's kind of describes where we've been. The pandemic, the fever broke. The fever broke in June. And by the Fed's preferred measure of core PCE inflation, we're there. On a 3 and 6 month basis, we're at 2%. Once we get Friday's number, and we expect in the months ahead, like we're at their target. We don't need grandiose victory declarations, but we are in fact there. The measure we like to look at as confirmation of this is the diffusion index, so the percent of prices rising versus falling. In the 1970s, this was 100% for several years, so all prices were rising. We got into the 90% on the diffusion index during the COVID inflation regime. Now we're at 37% as of November. Very, very well within pre-pandemic norms, very consistent with the numbers we're seeing on core PCE inflation. So again, we don't need the Fed to declare victory, but we'll go ahead and do that. We are there. It reflects multiple factors. I agree with Jason. It's not all sell side. Monetary policy did some of the job here. The combination of factors includes fading of the one-time fiscal helicopter drop. So we also don't equate deficits with inflation. It matters what the government is spending money on. One-time large helicopter drops have a more inflationary impact than, say, investment in chip factories. The fading of that has contributed to it. The balancing out of demand between goods and services. That was a key element of the pandemic inflation. It was effectively a boost to the budget constraint of consumers that they were simply not able to spend money on services. They became less price sensitive on goods. And that was a critical element that is gone, completely gone. And the end of YOLO, so you only live once. Consumers spending out of their own money are more price sensitive than when they're spending out of helicopter drop money. So also consumers are not in some kind of existential crisis like we were in a pandemic. They are working, they're looking forward, they're making plans. And by all accounts, including companies and the Beige Book that just, the most recent Beige Book, consumer price sensitivity has returned. It's really hard to measure, but that's one of those factors that can shock you into a different regime and shock you back. Consumers are more price sensitive. And then of course, tighter money and tighter monetary policy play a role. So we're back in the pre-pandemic regime. We actually see risks this year that we could undershoot 2% if we get both the moderation on rental inflation and falling car prices. We're kind of going to, but combination of very reasonable things could get you to 1.5 for a period. So we're more of the mind. We see less upside risks, I think, than Jason. So, if the economy is fine and inflation is coming down, one thing we often hear is, why should the Fed cut rates? And here we're more in line with Jason. Monetary policy is tight. It's too tight. The Fed over-tightened because it thought it might have to do more of the work. It turns out that it doesn't. There's a lot of these factors that are interacting with each other. It doesn't need to do everything. How do we know monetary policy is tight? Well, the curve is inverted. And that real rates are high. They're higher than they ever were last cycle. There are reasons to think rates can be higher this cycle. I agree with Jason on that. But an inverted curve tells you that the money multiplier is going to be very negligible, and that's going to be a restraint on growth. Where do we see that? Well, we see that in the banking system. The banking system is under pressure. So, last year we were very optimistic in January, and rates sold off. They went higher. That tipped over several large institutions. And we don't see any of that kind of rumbling on the horizon. The Fed kind of stood up its liquidity facility. But these are the losses, unrealized losses in the banking system. And they're still large, and they're still there. That's the left-hand side chart here. And so the losses from the shock higher in rates are real. They're on the bank books. They're still there. Banks are managing this. They're managing this risk. That's what they're supposed to do. So we don't see the risk of a financial crisis as particularly elevated right now. But what we have seen is that banks now understand that deposits can flee in a heartbeat. And that's a risk that they need to manage. That's a liquidity risk they need to manage on top of the interest rate risk that they've always supposed to have managed. And all else equal, it makes them they're keeping credit standards tight. The incentive for maturity transformation is low. The curve is inverted. The risks are high. And the right-hand side shows you just nominal bank credit growth. And it is basically ground to a halt. So we have lost the money multiplier. There is very little maturity transformation in the system. And so I do think that actually one area where I disagree with Jason is I think lags in monetary policy are certainly longer than they've been because households and businesses did a lot of refinancing to lower fixed rate debt during the record low interest rates of COVID. And that is still in the system. It's keeping these higher rates from biting harder than they would otherwise. But there is rollover risk. There's rollover risk in the commercial real estate system where there's also losses. There's just general rollover risk so that people move, businesses want to grow, their money's more expensive. And that's going to be a source of restraint. So there's no reason for the Fed to maintain this posture. And we do expect them to cut rates.
Julia, we might want to kind of move things along a little.
Okay. 3 structural things I want to touch on real quick. One is, yes, fiscal policy is a tailwind this cycle, not just at the federal, but also at the state and local level. It's much more normalized relative to last cycle. I think one of the things we realize is last cycle was the outlier. Government did not do its job. It was a constant headwind. Now we've got a tailwind from government. Labor supply is booming. Immigration is booming. You can look through these slides. The immigration flows are running 30,000 a month above pre-pandemic. Labor force participation has responded to the strong labor market, and we've gotten a robust recovery in participation. So labor supply is going to keep us on track. Immigration is going to keep us on track. And productivity is likely to be better this cycle. So we all know there's a kind of one-off dividend from the fading of pandemic frictions, but this is also the first cycle we've had without an investment recession. We had a mild earnings recession last year, but companies are pretty optimistic going into this year that they're going to be able to actually expand their margins. How are they going to do that? That's productivity. So we're not, making big bets on a strong productivity performance, but I think it's safe to say the distribution of outcomes is tilted towards a better performance this cycle than last cycle. So we've got some tailwinds. We've got a Fed that's recognizing that it maybe its job is getting close to, and at a minimum, as Jason said, the Fed needs to adjust the nominal funds rate to reflect lower inflation. Inflation is lower. It's lower on a 3, 6, 9, 12-month basis. You don't need to be at 5.5%. You can lay out a strategy of gradually adjusting that rate to prevent an unwanted tightening. So I will end there and hand it off to Nathan.
Great. Well, thank you very much for that very stimulative and informative discussion, which covered, similar bases to what Jason covered, but, different areas of sectoral detail. I'd like to just follow up on the discussion of how restrictive Fed policy is. 'Cause you certainly made a good case that it is pretty restrictive, but other people have made cases and published financial conditions indices, that suggest that Fed policy is not so restrictive. Obviously, the stock market moving ahead very briskly. Credit spreads for corporate bonds, including high yield bonds, still quite narrow. And so what do you make of that? How do we compare what seems to be a certain amount of exuberance in financial markets with other indicators that the Fed is being quite restrictive?
So the Fed published their own financial conditions index, which I was very glad to see. And they mapped it into what maps best into GDP.
Yes, right. Mm-hmm.
So it's much more heavily weighted towards mortgage rates, which are in virtually no other financial conditions index out there, but are extremely important to households and just in general to real rates. So that metric still shows that financial conditions are a headwind. On the stock market, I just say the stock market is nominal. We should think about that. It's just like people saying, oh, consumer credit cards are at an all-time high. That means nothing. It means zero. You want to look at it relative to income. What is the stock market relative to GDP? What is the various measures that adjust for inflation and interest rates, like the CAPE measure? It's even on a nominal basis, we're just reaching prior highs that we hit like 2 years ago. So I don't think that financial conditions are fine in a lot of ways, but money is tight. The cost of money, the cost of borrowing, the cost of creating a credit multiplier is high. And so we're not going to get that as much.
Well, maybe to shed more light on that, we need to hear from somebody that actually works for a bank. Not necessarily a very profitable bank, but a bank nonetheless. So why don't we see what Nathan has to say about the U.S. and global economy? And Nathan, why don't you go ahead and, after you finish swearing at me, unmute yourself.
Yeah, thanks, Steve. There are a number of things I could think to say in response to that introduction, but none of them would get approved by my public affairs people. So let's just set aside the issue that you raised. Now, you earlier, I think, in a slightly more serious vein, asked me to focus on the global economy. And so what I'm going to do is talk about, broadly speaking, similar issues to those that Julia and Jason have addressed, but try to do it a little more from a global perspective, even though there are places where the U.S. is pivotal in the global outlook, and there are also some places where the issues are resonant. My first key point today is that, like the United States, the global economy surprised us significantly on the upside in 2023. As the year began, we expected the global growth was going to fall significantly below trend. We were talking about rolling recessions, many different countries experiencing recessions over the course of the year. And in the event, what we ended up with was a global performance that was slightly, but only slightly below a trend growth rate. So really in the neighborhood of normal. And there were significant upside surprises in the United States, as we've described, but in other parts of the world, maybe most notably in some Latin American economies, including Mexico, which has some linkage to the United States, but really was about domestic demand, and in Brazil. And when I look around the world, I get a very similar story in terms of strong consumer spending. And over the last year, we've seen particularly strong consumer spending on services as consumers coming out of the pandemic have wanted to have those experiences. And significantly, as they spend on services are labor intensive, we also see in a number of countries around the world very low unemployment rates and tight labor markets, which has passed through into rapid wage growth. And importantly, what's happened then is that rapid wage growth has in turn fueled ongoing spending in the consumer sector. So you've had a virtuous dynamic supporting growth around the world. And I really see that the strength of the global economy has been the resilient consumer. Now, I can also say that there's a flip side to that. And the flip side is a very similar dynamic has been driving global inflation. And so from a growth standpoint, it's virtuous. From an inflation standpoint, it's challenging. And I think that's those are some of the key processes that were in play in 2023. Now, going forward, and hopefully without contradicting myself here, we do see a meaningful and broad-based slowing in the global economy during the year ahead. Our sense is what happened in 2023 is likely unsustainable, and there are some powerful forces that are likely to be in play. Now, specifically, some of those places in the global economy that were relatively strong, like India and China, we see growth remaining strong, but stepping down. Now, the China story is a little complicated, and if I have a minute, I'll come back to that at the end of my remarks. But Chinese growth, once everything was said and done last year, came in a little bit over 5%. And our expectation is it'll be a little bit under 5%, but broadly in the neighborhood of where we expect the growth target to be. By the same token, those economies that were weak last year, principally economies in Europe, the Euro area, the UK, and Sweden, are going to stay weak. And for the Euro area, our sense is that they're in recession as we speak, that the economy contracted in the third quarter, it contracted in the fourth quarter, and it's likely to contract in the first quarter of this year. Now, these have been relatively mild contractions, and my Europe team would probably prefer me to describe it as stagnation, but it does have a sustained minus sign on growth. So the strong are going to be a notch softer, the weak are going to stay weak. And then our sense is that some of the upside surprisers, like the United States and some of these Latin American economies that I mentioned, are likely to slow appreciably. Now, our formal forecast, we continue to have the call for U.S. recession. My personal view is that's a very, at this stage, that's a finely balanced argument. We are a little bit more in the camp with Julia that there are some important monetary headwinds that are playing through and are likely to continue to play through, and we think we're seeing that. But by the same token, I think Jason pointed out that the data are very compelling. And, we're left to say, what do we believe, our theory or our lying eyes? And that's kind of where we are. Being economist, I kind of say it's 50-50. But in any event, I feel comfortable that the U.S. economy is going to slow. Now, when I step back again, kind of thinking about the global process, I would characterize this slowing as reflecting 3 or 4 fundamental factors, which I'll go through fairly briefly here. The first is, as I've alluded, global central banks have been very vigorous. And our sense is that there continue to be lagged effects from that monetary policy tightening that are working their way through this system. Second, this spending by consumers and the resilience of the consumer, and particularly the spending on services, looks to us as like it is nearing a place. And I think Julia argued that for the United States, it's essentially played through. And that broadly speaking, globally, it's coming to a place where it's likely to step down. So we see the global consumer taking a breather in 2024 as the monetary policy plays through and the consumer softens a notch. That's likely to loosen up these labor markets around the world. And then finally, globally, fiscal policy is likely to be less supportive during the year ahead. Now, if there's good news associated with the slower economy, it's that it should also be helpful in taking some of the heat out of global inflation and open the door for central banks to ease up on their policies a notch. We expect most of the DM central banks to be cutting rates around mid-year. To be concrete, we have rate cuts in the U.S. by the Fed and in the euro area by the ECB, both in June. Personally, wouldn't surprise me in this cycle if the ECB moves a little bit earlier than that, given the weakness in the economy that I described. We also expect euro area inflation to fall off quite sharply. And then finally, let me just say a brief word on geopolitical risks, which I really think are important in thinking about where we are at the moment with the global outlook. One key risk that remains in play, I think it's more kind of a fixed effect in the global outlook right now, but it's still there, is the Russia-Ukraine war. And that is Europe has had a really rough year, 6 quarters. And I think there are ongoing headwinds, maybe particularly from the energy situation. They're not as intense as they were, but that is still the conflict there is still casting a shadow over global performance. Second, and more recently, I see the situation in the Middle East as being really uncertain, and this is a place that I would say is particularly uncertain. We know that there are a lot of adverse scenarios that might arise, but what kind of a probability to put on them and how it's actually likely to play through, I think is an open issue. If there's anything that gives me pause, it's that we've seen recently a new channel emerge where those tensions are disrupting global shipping. And specifically, we've seen an upsurge recently in global container shipping costs. That's only a fraction compared to what we saw during the pandemic. And I don't think it's a game changer in the global disinflation effort, but it's certainly something to watch. On the other hand, if there's anything that I find encouraging, it's that the oil market is crunching the probabilities of all these different outcomes and thinking hard about the various risk scenarios. And the oil market has been reasonably relaxed over the last month or 6 weeks. But that's certainly something we're watching. And then finally, it's been widely reported, but it's worth mentioning here as well. 2024, we're going to see literally dozens of national elections in countries all over the world. Already, we've had a national election in Taiwan, which has raised some questions about the ongoing tone of the relationship between Taiwan and Beijing. And I think that we're likely to see those kinds of things play through over and over again, with, of course, kind of the big kahuna for elections being the US in November. And I think that through the backside of this year and into 2025, that's likely to be a factor influencing markets, investors, and sentiment. Steve, so with that, I think I've probably taken my 10 minutes, maybe even a couple of minutes longer, hopefully not 2 minutes longer. I'll stop there.
Well, thank you for a very interesting and informative discussion and for your, at least your interest in adhering to the time limit.
Exactly. It's the right spirit, whether I actually execute it or not.
Exactly. So what I'd like to do, is follow up in terms of these different risks, especially geopolitical risks in the global economy that could affect the U.S. economy. I'm going to guess, and like your response, that some kind of a slowdown or crisis in China probably would have larger impacts on the United States than, Red Sea issues, Ukraine issues, et cetera. And I was wondering if you could speak to that. And then also, because you said you might come around to that, talk a little bit more about how you see the China situation. Are they already in a financial crisis that could stall their economy, or are they just in kind of a rocky period that they'll come out of?
Steve, let me start that question by talking a little bit about the outlook for China, and then get into some of the risks. And as you said, I'll be brief. Our baseline, as I alluded, is that Chinese growth is likely to be in the neighborhood of 5%. After a period of pronounced softness, we think that the Chinese consumer has kind of hit bottom and is now at a place where we're likely to see a reasonable kind of rate of consumption growth and private spending in the Chinese economy more broadly. That will be further supported by ongoing fiscal stimulus, including we are likely to see in the coming year a reemergence of just old school infrastructure investment. And given all of that, kind of our expectation is that China is likely to be fine for the next 12 or 18 months. I think the major downside risk for the Chinese economy at the moment, and I very much heard this, I was in China last month, and I heard this from folks that I talked to, I even heard it more keenly from folks I talked to in Hong Kong, is there is a lot of worries about the Chinese property sector. My expectation is that the authorities will be successful over the near term, at least, in putting a floor under it. So it's not a financial stability risk, but it's also not going to be a driver of growth. But that seems to me to be the major free variable. And then the other key thing I need to say is, even in the last day or two, there's been reporting that the Chinese government is going to mobilize a massive package to support financial markets. And I think that's something to watch. And again, if they want to drive up asset prices in China for a while, they have the resources to do it. I don't see it as fundamentally changing the outlook. Given all of that, I think there are lots of long-term risks: debt, leverage, aging demographics, geopolitical risk, questions of what's going to drive growth. So I don't want to get too bullish on China in the long run, but for the next year, I think we're okay. And then finally, I very much agree that if there were some kind of a serious disruption in China, or some kind of a geopolitical event involving China, that would be a first order disruption of the global economy, including for the United States. Now, the one kind of softening thought I'd articulate is, if we had this panel 2 years ago, and we'd played through some of the scenarios that have actually occurred in Ukraine, I would have been very concerned. And what we saw was, yes, some upfront disruption, and it continued, as I said, to be something of a headwind, particularly for Europe. But the global economy, notwithstanding those challenges, has shown an extraordinary ability to rewire itself, and in response to these shocks, to respond very, very flexibly and find ways to allow economic activity to continue. Now, that seems to me like a much bigger challenge if you've got a China shock, but the flexibility of the global economy has been extraordinary. And I think that's something we need to bear in mind in thinking about those kinds of challenges.
Excellent. Well, on the subject of deep financial issues, I think Desmond will carry on our conversation focusing on the US of A, but maybe a little bit on China as well.
Thank you. Let me see if I can share the screen. Thank you, Steve. I guess I'm going to be not in this consensus of discussion so far, and I take comfort in the fact that the consensus is generally wrong. At least it's been wrong in the last couple of years. They didn't get the inflation right. They didn't get they thought there was a recession. That didn't occur. And I think that now they're being far too optimistic about the outlook. And I agree very much, that we've always got a constellation of risks. But where I disagree is that I think that this combination of risks is so large that I find it difficult to think that everything is going to go just right. We're going to have enormous luck. So let me just say what are the risks that I see. The first are the geopolitical risks that I'll talk to about each of these risks, but I think that it's important to see them as a combination. That we've got a whole lot of things on the downside that are bothering me. So it's the geopolitical risks. Then there's the whole issue of the commercial real estate bust and the regional bank vulnerability. We've then got an external situation that looks really pretty bad. I'm far more negative on China than Nathan seems to be. We talk about that a bit. And then there's the whole question of the delayed effect of monetary policy, that there's a huge money supply contraction that we haven't seen before. That gives me pause. So let me talk about each of them very briefly. Just the geopolitical risks, we all know about them, but when you add them all together, it's not good that we've got two hot wars going on at the same time. You've got the largest land war in Europe since the 1945, and we've got this Middle East situation that really looks like it could spiral out of control. You've got the Nathan mentioned the Houthis threatening to block the Red Sea. But what they didn't mention as well is we've got China expressing displeasure over Taiwan. So there are plenty of things just on the geopolitical side, and these are not minor issues. If we get an oil supply disruption, if we get supply chain problems again, that is huge. Then we move on to the commercial real estate, what I call a slow motion train wreck that we've got in real estate. And the real story is there's two factors that are causing the problem here. Well, there are three. The Fed easy monetary policy caused a lot of bad decisions to be made, over a very prolonged period of time. But now what we've got, the problem is in post-COVID, people have changed their habits, and now we've got high interest rates. So what we're seeing is people just not going back to work, at least on a full-time basis. This chart just shows a bunch of cities where you're seeing that the number of people not going back on a full-time basis is rather large. And what that's being reflected in is vacancy rates that are at all-time record levels. And those vacancy rates, this is at a national level, we're pretty close to 20%. We've got to go back to 85, 86 to see that kind of situation. And what we've got to expect is these vacancy rates to continue rising as leases expire. So there's something very basic, very fundamental that has occurred in a market that when we look at commercial real estate in total, you're talking about a $20 trillion market. So if you've got a problem there, that is something to really worry about. What we're seeing that prices have already fallen, and this is not just a United States problem. This is a problem in Europe as well. So, for instance, this chart is just showing you commercial real estate property, office properties in San Francisco down by something like 60%, Los Angeles 50%, New York the same. You go, but it's also Frankfurt, Dublin, Paris, London. You've got a huge problem on the real estate side. So we're hearing people talking about possibility of having defaults over the course of the cycle. You've got $1.5 trillion of loans coming due. if you get a lot of defaults on that, you could have defaults of $700 billion to $1 trillion quite easily. Prices, as I say, falling. This are people forecasting prices at a national level. Office buildings could be down 30%, 40%, from the whole of the cycle. The IMF came out with a chart that is rather interesting, just showing that previous tightening cycles, these are Fed tightening cycles, this cycle, commercial property prices are falling at the fastest rate. So that is a problem for the whole of the banking system, but it's a particular problem for the regional banks, because the regional banks have got something like 18% of their overall book is commercial property loans. If you look at the amounts that are involved, exposure to commercial real estate for the small banks, it's something like $2 trillion. For the large banks, that's $1 trillion. So if you do get defaults, this could be serious. And I think that Julia showed the same slide. When you're now having to write down commercial property loans, you've got to write down auto loans, you've got to write down home loans, you've got to write down credit cards, the whole works. But what we've also got on top of that is the banks are sitting on massive mark-to-market losses as a result of the high interest rates. The fact that long-term interest rates went high means bond prices fell. These banks are loaded with the stuff. The estimates are something like $600 billion. So there's a recent NBER study that is showing that it's likely that in the cycle we're going to see close to 400 small banks fold, and that has to be a downside problem. So much for the commercial property, regional banks, and the geopolitical side. When we look at the external side, you've really got real problems. I don't buy Nathan's rosy view of China's outlook. China's got a fundamental problem that we've had the largest housing and credit market bubble known to mankind. This is larger than what occurred before Japan's lost decade. It's larger than what occurred before the US housing bust. So this is a long-term problem. I think that China is on the edge of a Japanese-style lost decade. It's not going to go belly up like the United States did in 2008 because the Chinese can intervene. But you've got a problem in China. And then in Europe, Europe's in recession. And I don't know whether it's escaped people's notice that the periphery of Europe, the Eurozone countries, places like Italy and Spain, their debt levels today in relation to GDP are higher than they were during the debt crisis. So, that's another area where things can go wrong. So we've got that on the external side. Just to close out, I agree with Julia that monetary policy operates with long and variable lags. And that is important, when we look at the degree of tightening that we've seen. This looks at previous tightening cycles. The black line is what this current cycle is, this 5.25 percentage points. That is a huge tightening in a very short space of time. And we could see problems. I'm not a monetarist, but when I look at a chart like this, I really do think that monetarists might have a point, that maybe inflation is always and everywhere a monetary phenomenon. And you see what occurred in 2020, 2021. The Fed allowed the money supply to increase, broad money supply to increase by 40%, something we've never seen in the post-war period or since they've begun publishing these statistics. And now it gives me pause that we're seeing a monetary supply contraction, the likes of which we haven't seen in the last 60 years. So I am in the camp that we're going to see interest rates a whole lot lower we're very likely to see a recession, and I don't think things are going to work out that well. So I disagree with. I notice, just what gives me greater conviction in my view is that a poll came out yesterday that 91% of economists think that we're not going to have a recession. So I take the other side.
Thank you, Desmond. You could probably stop sharing your slide unless you want to
Okay, sure.
cogitate on that a little further. It's a very interesting chart, that's for sure. I wanted to and thank you for that very nice review of the kind of like larger maybe tail risks or not so tail risks that assail our economy. I wanted to follow up a little bit on this issue of the problem in commercial real estate and the regional banks. I believe the regional banks, only account for maybe less than 10% of total bank loans in the United States. But you seem to suggest that problems in that sector could have outsized impacts on the entirety of the economy. So I was wondering if you could talk a little bit more about that, and maybe also talk about to what extent some of these problems would be alleviated, given that interest rates should be moving down this year.
No, I think interest rates will certainly move down, if things come unstuck, if things come unstuck in the commercial property market, the way in which I think they're going to, over the next year or 2 years, that looks like it's baked in the cake. We know that there's $1.5 trillion of loans that have to be rolled over at very much higher interest rates, and they're not earning any income. And, we're already seeing places like Blackstone and BlackRock or whatever, big property developers actually walking away from their loans, so that is bad. I'm saying that the regional banks are the ones that are going to get hit the hardest. And you're right that they've only got something like $3 trillion in loans. It's only something like 15% of the overall banking system. But it's the banks as well, that the whole of the financial system is going to have to be eating up loans. So if these kind of numbers occur, that you're going to get defaults on something like $700 billion to $1 trillion, I don't see how that's not going to have an impact on the financial system. And the important thing is not to view it in isolation. You've got to view that at the same time that, you yourself mentioned that their default rates in other kind of loans, and then they've got this problem, the mark-to-market problem. One of my charts showed that there are a whole bunch of banks, if you mark them to market, these guys are underwater. So this to me doesn't look like it's that stable a situation.
Well, that makes sense. I would say, given your perspective on downside risks, maybe some of our viewers might be interested in how you've configured your own financial portfolio.
Well, if I've got to talk my portfolio, I'm along up to the kazoo in long-dated U.S. Treasuries.
All right, well, that sounds safe. I guess if they want more personal financial advice, they can contact you separately.
No, don't. I'd rather.
But Desmond, isn't that what bank portfolios also have on their books?
Yeah, but the difference is that they bought those bonds when the interest rates were 1%. I'm buying them when they're over 4%.
That sounds like a good strategy to me. So anyway, thank you for that. And so now that we've kind of finished our sort of top all of our panelists, I'd like to offer the opportunity to any of the panelists to kind of like, offer their views on some of the other things they've heard, or amplify on any comments that we might have misinterpreted.
So maybe I'll start.
Sure.
There's always recession risks. There are always scary things in the domestic economy. There are always scary things in the global economy. The track record of anyone who forecasts 3 out of the last 3 recessions is basically nil. There's the 6 out of the last 3 people and the 0 out of the last 3 people. I think there's some judgmental reasons I can convince myself that the risks are elevated right now. And I gave some of them before. but I think it is just folly to ever think have more than a 50% probability of a recession over next year. And I've committed that folly myself recently and historically tried to avoid it. I just think we just don't know enough about all the random shocks, how the economy works. We just don't know. It's not quite a roulette wheel, but it's a lot closer to that than it is to a beast we understand. The second thing that gives me a little bit of confidence on the financial system is that there is much more of a Fed put on financial stability now than there was a year ago. A year ago, we ran into problems at Silicon Valley Bank, and that barely changed the trajectory of monetary policy. They were probably going to do 50 at the next meeting. They did 25 basis points instead. But other than that, they just proceeded full speed ahead. And that's because they were really, really worried about inflation. They're just less worried about inflation now. If serious financial problems start to emerge, they will cut interest rates aggressively, and they'll do that not for the sake of the financial system, but because of their dual mandate. They're not going to be worried about inflation in that circumstance. They are going to be worried about the economy. And so I think that's a really profoundly important difference and way in which the world is safer now than it was a year ago. The third thing I'd say is I think all of this conversation leaves me, if anything, listening to everyone a little bit nervous that what you described, Steve, as a dovish position of a modal cut rates every other meeting starting in March, maybe isn't enough. Rates are tight. I agree with Julie. I said that myself. I agree with all of Desmond's things, maybe not the magnitude, but the sign. And I agree with ways in which Nathan pointed out some of the softening of the economy. So maybe risks are tilted even more in that direction, but certainly not so far that I bet on a recession now or ever.
Yep.
I'm happy to let me jump in and specifically jump in on a few of Desmond's comments. First, one on defense and then one on offense. So on defense, the last thing I'd want to do is sound rosy about the Chinese outlook. What I would say is that for the near term, I'm reasonably comfortable that the problems that are in play there are manageable and are likely to be kept at bay, and that with enough stimulus, and that is a question of how much will be necessary, with enough stimulus, they're going to continue to grow at this 4.5% to 5% pace that we saw last year. But by the same token, I highlighted the risk around property, but also I would not want to underplay the extent of the longer term challenges. The longer term challenges in China really are first order. And I think it's the debt and the leverage in the system, corporates, banks, governments, local governments that are in play. Aging demographics. At the same time, you have aging demographics. You have very high youth unemployment. And that's very concerning. If you're in a situation of aging demographics, where do you want to make sure you find employment? You want to make sure you're giving jobs to the young because they're the ones that are going to be working when everybody else is retired. And the fact you have high youth unemployment suggests inefficiencies in the Chinese labor market, and it's not adequately matching the workers with the jobs. And there's micro stories about that. So the aging demographics, the high youth unemployment, the geopolitical tensions, I really believe are taking a bite out of Chinese activity, limiting their access to Western technologies, and I think weighing on sentiment in the economy. And then finally, and maybe most profoundly, you have this issue of what's going to drive growth in China over the medium term. And I think the Chinese are hoping it's AVs and renewables and batteries and maybe even new age agriculture. But whether that's going to be enough to replace the property sector or infrastructure investment as in previous cycles is very much an open issue. And ultimately, I think if you're going to have sustainable growth in China over the medium term, it's got to come from the consumer. And I'm just not optimistic that you're going to see that. I've been in meetings with Chinese officials, and Steve, I know you have as well, for almost a generation now, for 15 years or longer. And they've talked about how they're going to stimulate the consumer and have consumer-driven growth. And it's still aspirational. So there are lots of concerns. I'd say where I'm a notch more sanguine maybe than Desmond is I don't see how all of that is going to bite in the very near term.
I don't know if Julia's been waiting to get a word in edgewise or not.
I will just add to this conversation that I'm very sympathetic to Desmond's credit perspective. I do think that's the single biggest risk I can see out there, a generational interest rate shock plus a real credit contraction, both in the commercial real estate sector globally, and the Chinese situation means, we do have a real credit headwind, I think, globally. And I will echo something that Nathan said too, that is so important and adds to the humility that Jason is recommending for us, is we consistently underestimate how resilient companies and people and countries are in rising to the occasion of shocks. And if anything, COVID has shown us this in spades. And the most recent example last year, again, was, as Nathan pointed out, the European response to the Ukrainian shock, the war, was above and beyond anything we imagined possible, kept them out of recession for the year, and is still delivering resilience in the labor market. So I think that we always need to bear that in mind. And one of the things that I think gets underplayed relative to the rise of global fragmentation risks is that we've never had more technological tools at our disposal. Look what we're doing. We are collecting a group of people that are not in the same city. We have not had to waste our time getting on a plane and getting sick because we got some virus on an airplane. We're, getting together and sharing ideas and remotely. And there are just so many ways that we can do this now. I think that's the disinflationary, productivity enhancing force that gets under discussed relative to the global fragmentation risk.
Can I say something about interest rates, Steve?
Sure.
It was on my
I
list
wasn't
of
sure
risks.
how to respond to Julia, so this is good.
This is related to it's related to Desmond too. It was on my list of risks, but we shouldn't forget that interest rates have another side. From the perspective of banks, there's the deposit franchise. Banks basically make money by paying people a 0% interest rate. I think my checking account is now up to 0.25%, so I'm grateful.
You need to go to a money market, Jason.
I have money there too, but my checking account 0.25. And then they're lending it out and they're making something close to the interest rate. So the value of that deposit franchise, an estimate I saw a year ago, was about nearly $2 trillion. I'll bet that's about where it is now. Then the other way in which interest rates matter is there's the coupon clippers like Desmond over there, putting their money in long treasuries, collecting their coupons every quarter. And that interest rate is higher than it was before. The reason why we tend to not think of big lags in monetary policies, there's two types of effects. There's the marginal effect. Should I make this investment choice, which depends on what you get on the alternative, what the cost of money is. That basically happens immediately, and it doesn't matter how long the rates have been as high. And then there are these income effects. You refinance at a higher rate and you lose money. Those mortgage people do, but somebody else is getting more money on their interest rates. And we think those income effects sort of roughly cancel out. And that's why interest rates are two-sided, and the time part of it is two-sided as well.
No, I guess I've got to disagree, fairly strongly. That problem is that we've had far too easy monetary policy for far too long by far too many central banks. I'm talking not about what occurred the last 2 years. I'm talking about the whole response to the financial crisis. We've seen balance sheet expansions of the main central banks. The Fed has now got a balance sheet of about $8 trillion. They've bought a whole lot of assets. They've caused mispricing in the markets. There's far too much debt sloshing around all over the show. And when you raise the interest rates, that's when things come unstuck. So this is very different from previous periods in that there's just far too much debt out there. There's far too many investments that have been made in a poor way. And now the chickens will eventually come home to roost. It's both in the United States. I'm saying that you're seeing that in the commercial property. You're seeing it in Europe, with countries like Italy got debt levels that are huge. That's fine when the interest rates are low, but as soon as you raise the interest rates, then you get the stresses in the financial system. And that is something that the economists were very poor at in 2008. And I'm suggesting that they're not seeing it right now.
I just would say quickly, I agree with you, the Fed was too loose, but I put it in a much more circumscribed period of like 9 months from late 2021 to mid 2022. Second, the Fed has a mandate. It's an inflation and output mandate. We did not have high inflation. We had low inflation for the period prior to 2020. And the third thing I'd say, Desmond, is, what you're saying could come about. It still could come about, but it's been a year now. People have been saying this for a while. We had a huge interest rate shock. And what do we have? A few horribly managed banks went away, and that's just fine. Nothing much more than that. I think we've had less financial instability than I would have thought after this rate shock, not more.
I think Desmond used a very key phrase that's worth us reflecting on, and that was when the chickens come home to roost. And I think what you're referring to, Desmond, and hopefully I'm not putting words in your mouth, is the interest rates, whether or not the Fed had the right policy, the wrong policy, that interest rates from central banks and along the curve for a decade were very low. And now we've gone through a period of normalization, and kind of thinking hard about what it means for the chickens to come home to roost, I think is very important for us. Now, for the United States, I've spent a lot of time trying to find data on household debt service and corporate debt service and looking at those data. And so far, there's very little imprint of these higher rates on debt service costs in the economy. And that kind of raises the critical question in my mind, is if rates are permanently this high, then I think that there will be some ongoing pressures, potentially including commercial real estate in high yield, and maybe in the banks at various points, they have to liquidate those assets. That's a more complicated discussion, but there will be some pain. But on the other hand, if the markets are right, and broadly speaking, the tone of what we've said here is right, rates are likely to be on a downward trajectory. And maybe by the time all of this actually has to be refinanced, people have termed out, it has to be refinanced, that then rates are lower and the pain's not as great. Now, a complementary kind of global observation here is that there are some countries in the world where rates have adjusted almost instantaneously on the stock of the outstanding debt. And Sweden is kind of the limiting case. The US is the place where there's been the least adjustment, and Sweden is probably the limiting case where there's been the most, where both the household mortgages and the commercial real estate, those obligations essentially float in real time. And those effects have essentially throttled Sweden's economy. And that process, again, to use your phrase, the chickens coming home, has been very painful. But the dynamics of that for the US in particular, I think, are pretty complicated.
I wonder whether, once we get through this situation and things get normal with like higher levels of interest rate, maybe the higher neutral rate that Julia alluded to in her discussion, whether basically having interest rates that are 2 to 3 to 4%, on the short side, for a prolonged period would basically lay the groundwork for a healthier financial system and better financial stability attributes. Than we saw during the 2000 teens when interest rates were close to zero for so long.
I think so. I think potentially so. If we can escape the chickens coming home to roost, or just have them come home like a few at a time,
Yeah.
then I think, we could have a better, more healthy yield curve, more healthy setting of interest rates. I'll rebut Desmond just once. I don't blame the Fed for policy being too easy over the prior cycle. It was the GFC, it was the private sector debt burden that had accumulated through the housing crisis that saddled us all, including the Fed, with zero rates for a decade. It was a balance sheet deleveraging. U.S. households were deleveraging their balance sheet on a debt to income basis for 10 years. That is a crazy headwind for monetary, and fiscal policy was a mess, and way too tight. And the Fed was left holding the bag. So I don't blame the Fed. I blame a lot of structures in the U.S. economy that we tried to get better. And I think we have made progress.
So on that note, we only have a few minutes left, and I'd like to give all of you an opportunity to leave us with some parting words. I will note that we have received some questions, and we haven't had time to address all of them, but one of them referred to the fact that with the long lags of monetary policy, if the economy does go into a recession, loosening now might not help that much. And so kind of with that, I'd like to, maybe in reverse order, have you each say a few words, and we'll wrap up and wave goodbye. So starting with Desmond.
Yeah, no, I think that interest rates will come down substantially, but they'll come down substantially because there'll be huge pressure in the financial system. So it'll be a repeat of something. I'm not saying that it's going to be exactly like 2008, but if you do get real stresses in the financial system, the Fed will go in again. They'll engage in quantitative easing on a massive scale, get us out of the mess, only to set us up for the next financial crisis 10 years down the road. So we just seem to be in this never-ending cycle of the Fed coming in, bailing the system out, getting mispricing and getting a whole lot more debt, and then we just have a bigger problem down the road. So my view is that we are going to see financial stresses. We are going to see the Fed cutting interest rates. And just to correct Jason, I'm not in this for the coupon. I'm in this for capital gain.
All right. Well, those types of stop-go monetary cycles are what keep us economists in business. But let's hear what Nathan has to say about that.
Well, let me conclude by addressing some of the existential kinds of musings that Jason's articulated during this discussion about kind of what we can know and how valuable our forecasts are. And, I agree that one of the great things about being a global macroeconomist is that it is an never-ending source of humility, that I'm constantly reminded that the global economy and economic behavior is infinitely more complicated than I can fully comprehend. And given that reality, we do need to be pretty modest about our forecasts and our projections. And a lot of different things clearly could happen. And the uncertainties always are very high. Now, notwithstanding all of that, I still believe that as economists, we do a service to policymakers, to investors, to corporates, in laying out some scenarios and some stories and some narratives about how things might evolve. And by putting those narratives on the table, I think it helps shape people's thinking and give them a framework for interpreting this massive uncertainty that Jason has described. So I think we have a role, but we have to remember that it's a limited role. The final point I'd make here, and this is something I've been reflecting on, is the frustration about many of us necessarily being chained to modal forecasts. I'm right now at a place where, as I described, our baseline view, our modal forecast, which is articulated by our chief US economist, is recession. But a soft landing is a very plausible outcome at this stage. But in a forecast document, I can only write down that modal forecast. And I think it does behoove us to think about more flexible ways to be able to articulate our views going forward.
Interesting. I would interject that, especially back when inflation was raging over 8%, I would have regarded a mild recession as indeed part of a soft landing. But why don't we move to Julia and hear what she'd like to leave our audience with?
So you've used two words that are like my least favorite words. One is normal. I don't like the word normal. There is no such thing as normal. We're never going back to anything. We're always going forward. Short, shallow recession is also one of those modal forecasts that I took great issue with. Recessions take on a life of their own. They are not to be trifled with, especially with all of the things that Desmond laid out. It would be foolhardy to think you could engineer a short, shallow recession. I was extremely worried about the Fed falling into that kind of thinking. Lastly, I'd say, kind of to this conversation of role of economists and forecasts, we do learn, and we're learning really interesting things right now. We're learning what does and doesn't cause inflation dynamics again, and I want us to really learn that. I hope that in the Fed's review that is coming up, its strategy and policy review, forget this, flexible average inflation. Who cares? Like, let's talk about understanding the inflation process and building a more robust triangulation of information, global information, financial information, sectoral information, interactions of things. We don't, simplistic macro models, that's good. Let's run those. That's part of the information set. But we can think more holistically and in more complex ways. And I hope that that's what comes out of this episode, is the ability to not shy away from using our toolkit. I mean, I remember doing this with the GFC. What in my toolkit still works? What do I need to add? And we do that again with COVID. What did we learn? Well, we learned a lot about policy experiments and what does and doesn't work, and what may work too well. And I hope we reflect on that, because I don't know. I do feel like we're moving forward as a profession, and I think we're in a really exciting time for macroeconomists. And I hope we don't revert back to using things that don't work, and keep moving forward and using things that do.
Thank you. I completely agree. I think it's been an extraordinarily informative few years for macroeconomists, and we have much to reflect on. Jason, what in particular should we reflect on?
Yeah, I just taught the first class of Intro Macro this week. And, one thing we tell the students is we just did micro. And in micro, we have random trials, we have natural experiments, we have all these amazing, powerful tools. No one can get 1,000 economies and have half of them raise rates, half of them lower rates, and sees what happens. So we're just operating in something where the outcome is the choices of 8 billion people. And as Julia said, it's constantly changing. Even if you could measure a parameter from a decade ago, there's no reason that parameter still holds now. So we have a really difficult thing. But I agree with Nathan, it's unavoidable. You need to do your best. You need to tell stories, put models. Part of your best, though, is to not be overconfident. If a friend of mine is going to a casino and wants to know where the roulette wheel will land, I'm going to tell them it's a 1 in 38 chance of any slot. They can be like, but seriously, I need something more than that. If I tell them definitely 17, that's not good advice. That's bad advice to them. And so that's why I think we shouldn't be overly confident. What I try to do is start with sort of just almost like a model-free historical baseline of what the chances are of the next year. And by the way, usually the answer is that next year is just like last year. That's why people didn't predict the inflation. That's why they didn't predict the inflation would go away. That model works most of the time. and then apply some judgment and shift it one direction or another, but don't shift it too much because we just don't know enough to shift it too much. Finally, that comes to the question that was about the Fed and lags. It's hard. The Fed's going to probably get it wrong, not because they're bad, but just because it's hard. How much did the economy grow over the last 4 quarters? One measure says 3%, one measure says it contracted. We don't even have a great measure of the last year, so now we need to do the next year. Monetary policy has lags. I see the risks as roughly even between inflation reigniting and a recession, which is why I would do a more modest path of rate reduction, but they should not at all be wedded to that. They should be ready to move and pivot quickly as the data starts to tell something different. So these conversations are great. We all have to try our best, but I think humility is part of what we need to do maybe a better job of than we did over the last couple of years.
Thank you, Jason, for that. And let me thank all of our panelists for providing really stimulating, interesting, and highly informative discussions. It was a real pleasure to have you here. I'm sure our audience appreciated it as well. And I'd like to thank our audience for joining us, and I hope we can all see you next time. And with that, we conclude our session.